If this is not the first video you've seen, then welcome back, teammates. But if you're new here, welcome. Today, we're going to talk about how to improve your credit score. There's a lot of information out there of the do's and don'ts and why your credit score might be bad. But before we get into the heart of the matter, we just want to briefly talk about various things that people might think affect your credit score, but they actually have no impact one way or the other. Many people might not be aware of this, but for starters, how much money you make, your age, and your employment history do not factor into your credit scores. Other details that don't influence scores include race or ethnicity, religion, nationality, gender, marital status, where you live, or your total assets. By now, you're probably wondering, okay, well, what does affect my credit score? Just how exactly is my credit score determined? We're about to tell you right after we make sure you know exactly what a credit score is. Simply put, a credit score is a number that estimates how likely you are to pay your bills on time and your likelihood of repaying debt like credit cards or loans. Creditors, meaning anyone you want to issue you credit that you have to pay back, use your credit score to determine whether you qualify to receive the credit you're asking for. They also use your credit score to determine the interest rate you'll pay and how much credit they are willing to give you. The higher your credit score, the better. A higher credit score can make it easier to get a loan, rent an apartment, or lower your insurance rate. Credit scores are three-digit numbers that range from 300 to 850. The scores are calculated from information in your credit report, which is compiled by credit bureaus like Equifax, Experian, and TransUnion. The most popular credit scoring model is the FICO score, which ranges from 300 to 850 as previously mentioned. However, there are also other credit scoring models such as Vantage Score. Okay. Think about credit score as a cake mix with six main ingredients combined together. Circling back to what impacts a credit score, up next are the six ingredients that impact your credit score, in addition to the way in which and to what extent they contribute to it. Payment history has a high impact. Credit card utilization has a high impact. Derogatory marks have a high impact. Age of credit history have medium impact. Total accounts have low impact. And hard inquiries have low impact. Don't worry if this long list just sounds like words to you. We're going to define each term. Payment history has a high impact on your credit score. This is represented as a percentage showing how often you've made on time payments. Paying bills on time shows lenders and creditors that you're reliable and more likely to pay back your debts. Late or missed payments can significantly harm your credit scores, so it's important to try to pay all your bills on time. Credit card utilization also has a high impact on your credit score. This refers to how much of your available credit you're using at any given time. It's determined by dividing your total credit card balances by your total credit card limits. Most experts recommend keeping your overall credit utilization below 30%. Why? Because lower credit utilization rates suggest to creditors that you can use credit responsibly without relying too much on it. Individuals whose credit card utilization soars above 30% may be more likely to fail to repay their loans than those who keep their balances low. Another benefit of keeping your utilization low? Having available credit can help if something unexpected arises, which you then have to pay for. Derogatory marks is the third factor that highly impacts your credit score. The good news is, as of July 1st, 2017, about half of all tax liens and nearly all civil judgments have been removed from consumers' credit reports. This is definitely good news because having those derogatory marks on your credit reports can lower your scores drastically. Still, there are other derogatory marks that may affect your credit score, including accounts and collections, bankruptcies, and foreclosures. Age of credit history has a medium impact on your credit score. This factor shows how long you've been managing credit. It doesn't refer to how old you are, as some might think. The longer you manage your credit responsibly, the more you demonstrate your credit worthiness to lenders. While your average age of accounts isn't typically the most important factor used to calculate your credit scores, it's important to think about. Closing your oldest credit card account, for example, could end up negatively impacting your scores. Have you ever heard someone say they were denied a credit card because they had no credit history? So, as you see, credit history is essential. The total number of accounts you have has a low impact on your credit score, unless, of course, they're all maxed out or have negative balances. This category refers to the number of credit cards, loans, mortgages, and other lines of credits you have. Maybe you should double check that your lenders are sending in reports to the credit bureaus because lenders generally like to see that you have responsibly used the mix of accounts on your credit. It generally shows that other lenders have trusted you with credit. Now, when I say that, people are quick to send in when you don't pay, so make sure they send in when you do pay. But if they don't tell them when you don't pay, don't remind them to tell them. Hard inquiries also have a low impact on your credit score. Hard inquiries usually occur when you apply for a new line of credit, such as a loan, credit card, or mortgage, but they can also take place when, for example, you rent an apartment. A lot of rental agencies check your credit score as a part of the application process. Hard inquiries can slightly lower your credit scores. A hard inquiry usually stays on your credit report for 2 years. However, it typically only affects your credit score for about 1 year. It's interesting to note that a lot of hard inquiries on your credit reports within a short period of time may suggest that you're desperate for credit or aren't getting approved by other lenders. It might seem counterintuitive. To build your credit, you need lines of credit. So why should your credit scores take a hit because you apply for a new account? Anytime you take on a new credit obligation, there's an element of risk. Credit models see that and want to understand if you're able to handle that new obligation. After you've made on time payments for a few months, the impact of that hard inquiry should go away or diminish. Now, before somebody gets on here and says, hey, you forgot something. No, I didn't. There's a credit check called a soft inquiry. A soft inquiry, also known as a soft check or soft pull, is a credit check that does not impact your credit score. A soft inquiry can stay on your credit report for 12 to 24 months, depending on the requested credit category. But it's not one of the six ingredients that make up for the score and thus does not affect the credit score one way or another. Whew, that was a mouthful. Come on, y'all, let's take a water break. Now that we've covered the definitions, what contributes and what doesn't contribute, let's cover the credit score ranges and the implications behind each one. The scores are divided into 5 categories. The first being poor, with a score of 300 to 579. In the poor score category, you can just forget about it. The chances of getting a credit card, loan, or even a rental application approved is highly improbable. The most likely type of credit you can get is a secure deposit. This requires you to make a security deposit up front, which acts as your credit limit, allowing you to build up credit by making timely payments and responsibly managing the card usage. But the interest rate is probably higher than normal. Perhaps you've heard of some car dealers offering credit approvals for car loans with no money down and no credit check. What they don't tell you is the interest on those car loans are going to be double, sometimes triple the rate than that of people or for people with a higher credit score. To break this down even further, for example, if your credit limit is $2,000, it's because you paid them $2,000. It's essentially as if they're holding the money for you. You pay them the $2,000 and that's all you have to work with. A fair credit score falls between 580 and 669. With a fair credit score, you most likely cannot get approved for any credit card you want, but there are still options to choose from that offer rewards programs, no annual fees, and other benefits. Good options for this range are store cards, student credit cards, and cards geared toward fair credit. Lenders may consider you to be a subprime borrower and charge you more upfront fees and higher interest rates. You might even have trouble getting approved for certain financial products like a house mortgage. A good credit score, 670 to 739, can give you access to a wider range of credit offers and providers. It can improve your chances of getting approved for credit cards, loans, renting an apartment, or getting a mortgage with better interest rates. Some employers may check your credit as part of the interview process, especially in sectors like finance or law. You may be able to negotiate better terms on loans. You may even be able to get better cell phone plans with lower monthly payments and upgraded devices. 740 to 799 is very good. People with very good credit can borrow money at a better interest rate and qualify for the best credit card deals. This score can get favorable terms on a new cell phone and improve your chances of renting a home, as well as get you better car and home insurance rates and skip utility deposits. It can even help you get a job that's in part based on your credit score. Why are jobs based on credit scores? You need a job to pay your bills to get credit. Hey, excellent. 800 to 850. With an excellent credit score, you can access more favorable financial options with better conditions. Essentially, you are deemed a reliable borrower. Essentially, you are deemed a reliable borrower. Oh, essentially, you are deemed a reliable borrower with low risk to lenders. You can typically access better loan terms like lower interest rates on mortgages, car loans, and personal loans, qualify for premium credit cards with high rewards, potentially get lower insurance premiums, and have a higher chance of approval for rental applications. Take a look at this sample credit score. Each credit bureau has a different credit report. Remember the score ranges? In which category would this sample credit report fall? Be sure to come back for part two, where we'll talk about ways to bring the credit score up. Don't forget to like, share, and subscribe if you like this content. You know what? If you subscribe, you can turn the notifications off. Most people say turn on the notification bell, but we don't mind if you turn them off because the upload will show up in your feed anyway. We promise not to bombard you with notifications every time a new video comes out, but we do need the subscriptions. We appreciate every one of you who subscribes because that enables us to be able to spread knowledge to a lot of people and continue to make this kind of content. All right, thanks for watching. See you in the next one. Okay, thanks. Bye.